Hello and welcome. Today we'll be discussing bonds. Bonds are a popular method of financing in which an entity raises money by issuing a security to an investor with fixed terms of repayment. The indebted entity issues a bond that outlines contractually the interest rate or coupon that will be paid to the lender, as well as the time at which the loaned funds or bond principal must be returned, known as the maturity date. Basically, bonds can be thought of like IOUs. The issuer of a bond borrows money from a lender or creditor and pays interest for this privilege. Corporations or governments issue debt as a means of raising capital, often to finance new projects. Unlike with stocks, bonds do not represent an ownership interest in an entity, and unlike with common stock, they do not include voting rights. As a result, bondholders have much less control over an entity to which they have lent money than do shareholders who have invested in an entity. Bonds are fundamentally similar to taking out a loan from a bank. Just as a bank checks your credit score before granting you a loan, it is important to examine the financials of a company before agreeing to lend them money. Bonds are higher in the corporate claim structure than stock, meaning that in the event of liquidation, bondholders will be paid back the money they are owed before stockholders are allowed to exercise their claim to an entity's assets. This makes bonds and other forms of debt investment less risky than equity investing. However, there is still the potential for a debt issuer to fail to repay the lender or default on a bond. This is known as default risk. By examining a company's financials, though, the risk of default can be at least partially mitigated. Another source of risk that is more difficult for bondholders to manage is interest rate risk. Interest rate risk refers to the impact that changing interest rates can have on the attractiveness of a particular bond. So, bonds are a form of debt, but how does investing in bonds work? Well, when an investor purchases a newly issued bond, they purchase it at what is known as par value. Par value is the amount that a creditor lends to an issuer and is the amount that the issuer agrees to pay back at maturity, a predetermined time in the future at the end of a bond's term when the issuer pays back a lender's principal. The par value of a bond is usually $1,000, and a bondholder will generally receive interest payments from the issuing entity on a semi-annual basis for the life of the bond in exchange for the privilege to borrow their capital. The total amount of interest on a bond per year is known as the coupon and is generally expressed as a percentage of a bond's par value. For example, a bond with a par value of $1,000 and an annual coupon of 5% will return $50 in interest per year. Generally, a bond's interest rate is strongly linked to the possibility that the issuer will default on its payment obligations. A bond issued by an entity with a significant risk of default will usually have a higher interest rate, while a bond issued by an entity with stable financials will usually have a lower interest rate. A bond's interest rate is also linked to its term. The longer the term of a bond, or the longer the time until an investor has paid back their initial capital, the higher the interest rate. After all, investors will not be inclined to tie up their capital for long periods of time or to risk their capital unless there is some incentive to do so. Higher interest rates offer just such an incentive. Bonds are not always purchased at par. Sometimes bonds must be purchased at an amount above par, known as a premium. Why would anyone purchase a bond at more than its maturity value, you might ask? Well, an investor is likely to buy a bond at a premium, pay more than its maturity value, whenever its stated interest rate, and therefore its interest payments, are greater than those presently available from today's bond market. On the other hand, a bond may also be purchased for less than par value, also known as a discount. A bond is likely to be valued at less than par if its interest rate is less than available in the prevailing bond market, or if investors consider that the bond is risky in terms of the issuer's ability to make the required interest payments, and/or to pay investors back at maturity. A bond's yield refers to the return on investment that it offers over the course of 1 year. It is calculated by dividing the bond's coupon payment by its current market price. The higher the price of a bond, the lower its yield. In summary, a bond is a form of debt financing used by corporations and governments to fund new projects and ventures. By entering into a bond contract, a lender agrees to lend an entity an agreed upon amount of money. This is known as the par value of the bond. It is usually, but not always, in the amount of $1,000. In exchange for the privilege of borrowing the lender's capital, the issuing entity pays the lender interest on the loan at either a fixed or variable rate. This interest is paid to the investor until his or her principal, the money he or she initially lent the issuing entity, is paid back in full. The maturity date of a bond refers to the time by which a lender's principal must be paid back in full. Bonds, and debt investments more generally, are usually considered less risky than equity investments due to their more privileged position in the corporate capital structure. However, they carry the risk of default as well as interest rate risk. Thanks for watching, and as always, if you have any further questions, please do not hesitate to give us a call or visit our website.